Hello, fellow RoboCapitals. Hope you're well. I am back with my good buddy, Brien Lundin. And Brien, we got a lot to talk about, my friend. I think silver broke $40 today, if I'm not mistaken.
Yeah.
Give us the details.
Yeah, as we speak, silver is over $40. Gold on Friday, a couple of days ago, it broke through 3,500 on futures level. It is challenging that on a spot level right now. So it seems to me that the summer doldrums that we've been waiting to end has ended, and the new rally has begun.
Yeah, so whenever I look at a gold chart, it's interesting because it seems like it kind of goes straight up, then it consolidates for 3 months or something like that, and it kind of gets another leg up. I was listening to a podcast the other day where they had a hypothesis, and this guy is pretty sophisticated. He had a podcast, or he was talking about in this podcast, this idea that it goes straight up, and then it gets to a point where there's a lot of institutional holders. And they're at that level. They're like, okay, I'm gonna go ahead and hit the bid here because I've made a lot of money or whatever.
Yeah.
So they need liquidity. So they're selling at this price, let's say 34.50 or something. And so they're selling. Every time it gets up to that level, they sell again. Every time it gets up to that level, they sell again. So you get this kind of a lack of a trend. You get this channel, right? This consolidation. Yeah. But then once all of the selling is exhausted, then the demand is usually the same. And that's where you break through until it gets to that next level where there's another layer of institutional selling. Does that make sense to you, or do you have a different idea?
That makes some partial sense to me, but I think that the real reason why we've seen this, and this is why I've maintained that this bull market we've seen in gold is unique. You know, in the long history of gold bull markets, which for a 4,000-year-old asset stretches back only to 1971. But over that period, we've had 3 previous bull markets by my count, and this is the 4th. But this one's unique, primarily because, well, really for that very reason, we've had no real corrections other than the one right after the presidential election in the US. Other than that, the corrections have not been of the depth or duration that classic technical analysis would have predicted.
Right.
And my thought is that that's because what's been really driving this bull market has not been the ebb and flow of investor emotions that you see in a typical investment or typical asset, but rather the programmatic buying of central banks who really aren't subject to those, bouts of euphoria and despair that typically drive markets. So the corrections, instead of being steep declines and hitting support levels on the bottom, have just been really pauses in the ascent. Now, that said, this pause has gone on a bit longer than we've seen before, but it's typical seasonality. We in a bull market, the average bottom for the gold price in a bull market is any time from mid-July to mid-August. So that if you look at the charts with and really narrow in, that may have actually held this time. But I think what we're seeing now is not only the summer doldrums relenting, but also really a fundamental shift in sentiment for risk assets, because I look at what Powell did at Jackson Hole as just essentially unleashing the hounds and returning to an easy money environment. And that environment will be very bullish for the monetary metals, gold and silver. I think it's going to be bullish over the short term for all risk assets. But, the stock market is so toppy right now and overvalued that anything can happen there. I think gold and silver are the real beneficiaries here.
Yeah, and it hasn't panned out for Bitcoin. And Bitcoin got that big bid right when Powell came out and said that. If I don't have the chart in front of me, but if I remember right. And then it's sold off. I think it went up to maybe 113, 114. Now it's back down to, I think, 108, maybe 109. So it seems like the big beneficiary, the beneficiary who has seen a sustained increase has been gold and silver, and then the miners as well. I know for one of my model portfolios, the RoboCapitals Pro, I had a big gold position, and it started off as like 10%. of the portfolio.
Mhm.
Over the last year and a half, it's grown to a much bigger size, a much bigger percentage.
So are you
So
going to rebalance that at some point,
I
or?
did. I did.
Okay.
Yeah, like 2 months ago or so, I
Mhm.
sold off maybe $20,000 or $25,000 worth of the gold, just to rebalance. And then I mean, I didn't really rebalance completely because I went into the GDXJ. But that turned out to be a pretty good move so far, because although gold is at an all-time high, the GDXJ has really gone up quite substantially, more so than gold over that time frame.
Yeah, one of the things I track is the GDX to gold ratio. And of course, the GDXJ is probably just a bit, well, does follow that as well. And if you look at the 1st of August, it's like it got shot out of a cannon. It's
Yeah.
somebody fired the starting gun. And, that's a great proxy for Western investor demand for the sector. And I think at that point, my take on that is that the Western investors, the institutions, hedge funds, and the like are looking at gold and figuring there's another rally coming, but how do we play that? Look how far it's come already. Well, the miners are still, by every fundamental valuation metric, dramatically undervalued, even though they've doubled this year, not over the past year, they've doubled since January 1st, typically. They're still very undervalued according to price to earnings, price to book, price to NAV, et cetera. Their margins are just incredible and growing now every day. And a part of that is because energy prices have remained, fairly stagnant or steady, and that's really helped their margins. It's really been a perfect storm for the miners so far.
Is that their number one input, Brian?
Yeah, those big yellow trucks take a lot of diesel to move. Interestingly, if you look at post 2008, from peak to trough, with the Fed coming in, the rescue efforts to save the global economy, global financial system, the price of gold nearly tripled from 2008 to 2011.
Mm-hmm.
And over that time period, initially gold outperformed the miners. Then there was a spurt where the miners outperformed gold. Then the miners just went flat and did not offer any leverage at all to the gold price for the second half of that move. And that's because at that time, the price of oil went to $140 a barrel.
Right.
So even though the gold price at that point was going up 80%, the price of oil just collapsed their margins. Their margins weren't expanding at all.
In 2000, when did the gold peak out? Was it 2011?
It was 2011. It was the actual peak. It had kind of a secondary but lower peak in 2012, both during the summer. And then it was just, here comes a bear market till December of 2015.
Didn't the mine right at the tail end, didn't the miners just rocket higher in percentage terms? Maybe I'm not thinking about that correct, right? But even in that bull market, the miners from start to finish went up a larger percentage than gold, didn't they?
They may have from start to finish, but for a good portion, if not the majority of that bull run, they were not offering leverage to gold.
Okay, because the price of oil went up. I know in the middle of 08, I think it got to 120, 130, maybe higher. I'm talking about the price of oil.
Yeah, I think it got up to 140 at one point, if my memory serves.
And then what did silver do during the GFC? I know that gold, and I'm talking about 2008. So if I should pull up a chart, but just based on memory, I think gold went up or is doing well until the summer when we start to see some serious cracks. I guess that would have been maybe Bear Stearns. And after Bear Stearns, the market is sensing a liquidity problem, and then not just sensing, it had a liquidity problem. So then gold sells off quite dramatically. And then once the Fed comes out with QE, then it catches a bid and kind of just goes back up and then just rockets higher throughout 2009 into 2011. What did silver do during that time? Did it have more of a down move when we had that liquidity event, or was it more stable?
Typically, silver outperforms gold in both directions. So
Hmm.
if memory serves, I believe silver got into the low teens, 13, 14, something like that. But
Okay.
it's hard to detect any trend during that period because it was so volatile. Gold got down to about $700. It had just peaked over 1,000, got down to about $700, but it was moving $100 over every 2 sessions, up or down, either
Right.
way, depending on the headlines. But then it became obvious that the Fed and other central banks were coming in with a massive rescue plan, including this weird thing called quantitative easing and the like. The markets flooded, our investors flooded into risk assets and then flooded into gold and silver. So silver went from those teens, as I mentioned, to matching the 1980 peak of $50 in 20, yeah, I think it was 2011.
Yeah, that's really interesting. So this time around, I'm just wondering if you think that cycle will hold true, because typically what we see is the gold price go up, then the miners catch up and then exceed in percentage terms, and then finally you see silver go even higher in percentage terms than the miners, and that's usually the blow off top.
Yeah, the last part of your statement is what has actually been true forever. In every bull market, every longstanding bull market of gold, silver has outperformed gold. In my analysis, it's going to do that again because it always has, very simply put.
Yeah.
Uh, you know, keep it simple, stupid.
Right, right.
It should do that again. You know, there's no sure thing. We're just playing probabilities, and that's a pretty high probability. But the new truism is that gold and silver lag gold, but I mean miners in silver lag gold. But in the 1990s and 2000s, it was the reverse. It was an accepted wisdom that the miners usually preceded gold on these, especially in these intermediate rallies, because investors saw that coming up and tried, and the smart money went into the miners because they expected gold to rise, and were often correct. And not saying there weren't some false moves and false indications in the miners as well, but right now, because the central banks are leading the whole gold story, and it really isn't accepted wisdom that you need to be in gold on Wall Street yet, it's being dragged along. The smart money in Wall Street are trying to react instead of be proactive. So they are being pulled along and now trying to find some way to play this trend. And seeing that gold's gone up so much, the laggards are the way to play it now. And those laggards are the mining stocks and silver, because that's not what central banks buy or have been buying.
Is that an indicator you use to see what retail is doing? I mean, the main part of that question is, just for the viewers, the big price move from, let's just say 1800 up to whatever 34 can be directly attributed to central banks buying, not really retail at all. I think retail actually, up until maybe 6 months ago, as far as the percentage of retail owners, actually decreased. So it was all central banks, which makes a lot of sense because they don't want the counterparty risk. And but what indicator do you use, I guess that's the question, to determine when the retail investor is starting to buy, and therefore the probability of that big move up is getting closer?
Yeah, I think that you have to separate retail from Western in general. I look at it as Western demand, that being, Wall Street, hedge funds, institutional demand. Then retail are really the coin and bullion dealers. And I have a pretty good feel for that from my contacts and friends in that industry, on the ground in the foxholes, as it were.
Yeah.
And they're telling me that it's mostly been selling at these prices.
Really?
Yeah, because a lot of the buyers, a lot of the gold bugs are aging out of the market. In some cases, it's their kids that are selling, what dad had locked, in the bottom of the closet, and that sort of stuff. Or it's these old people who are just saying, I've got to cash out, and my kids aren't going to know what to do with this, and prices are high. This is the time to do it. So I don't know what's going to happen with that retail demand. I think gold and silver need to be the new thing the new AI, the new crypto to some degree to bring those younger people into the market, relatively younger at least, 40s and 50s maybe, when they're just becoming curmudgeons, like me, then maybe they'll start buying physical metals again. But it's hard to come into a market when it's setting new price records every day.
Yeah. So what are your thoughts on crypto and AI being the shiny object right now?
Yeah.
And that taking away from the retail component of gold and silver and the miners, and how that may make this cycle slightly different?
Yeah, it definitely has. Crypto, Bitcoin has stolen a good bit of what I believe is a speculative demand for gold.
Yeah. Yeah.
I don't know that it's stolen a lot of the safe haven demand for gold, but it's definitely hit it on the speculative end. I think the gold price would have started rising 4 years ago, 5 years ago, if it weren't for stealing that portion of the demand. And I don't think that gold and silver need to be the new AI or need to be the new crypto, because the markets are so relatively small.
Mhm.
They're really tiny. So if you can just stick a ladle into that tremendous cash flow or pools of money that are sloshing around the globe from one hot market to another, it won't take much to really send gold, silver, and mining stocks, the latter two of which are so tiny in relation to every other asset market on the planet. It doesn't take a whole lot of attention to the sector and money to really have it take off. And again, once it takes off from those low levels, then you start getting the FOMO hitting and more people coming to the sector. But it doesn't really need to replace those sectors, in my view, at least.
Yeah, it just needs to get on people's radar,
Yeah.
because let's be honest, it's not just because it's gold or silver or crypto or whatever. In today's day and age, we've turned the economy, and especially the stock market, into a casino. I mean, that's what it is.
Yeah, and you said you hadn't looked at a chart of Bitcoin recently, but I would bet that if you took that chart of Bitcoin, it has absolutely tracked the NASDAQ, or the NASDAQ 100. And somebody told me the other day they were watching CNBC, and those little price bugs that flip, on the bottom of it on the various asset classes, they saw Bitcoin price flash 12 times for every one time for the gold price. So I decided to watch that and check it myself. And literally it got up to 24 times in no flash of the gold price. And gold's at record levels, no flash of the gold price. And I gave up. So that gives you some idea. It'll make the headlines when it makes a new high or something. And really there's some analysts on there who are smart, and they'll say, they've been talking about gold, but they talk about it and then they're off, because there are not very many gold miners or gold oriented funds or whatever buying commercials on CNBC.
I was just going to say that.
But there's lots of Bitcoin commercials, lots of crypto commercials.
Yeah, but that's the opportunity. I
Yeah,
think
absolutely.
you've got something that's just flying under the radar in terms of retail, and it's hitting all-time highs. And you look at the chart looks great. And I had a question the other day in Rebel Capitalist Pro. They're like, oh boy, what do you think of gold now that it's at all-time highs? Is it overvalued? Is it expensive or something? And I said, well, I don't know how you want to value it. It's tough, because it's kind of like an insurance policy.
Yeah.
But I said, one thing that I can tell you, in all of and I've really changed my mind on this, quite frankly, over the last 5 years since I was doing videos. But at the beginning, I considered myself a value investor. I just want to buy something that was cheap. But then I kind of realized that there's some guys and gals that do that are very successful, and some that are not. And I realized the ones that are effectively trend followers, because what they're doing is they're just using value to find a trend, and then they wait for a catalyst. And I notice the value investors that don't make a lot of money are the ones that just buy something just because it's cheap. They don't look for a catalyst, whether it's technicals or fundamentals. Or a great example would be Milei, winning the election in Argentina. That's a great catalyst right there.
Yeah.
So my point to this person was that if I took 10 of the most successful hedge fund managers that I've talked to, I'll bet you 9 of them always say that they would prefer to buy something at all-time highs as opposed to all-time lows, just in general. And it goes back to one of these. I saw this thing the other day from Marty Zweig. Remember
Yeah.
Marty Zweig?
Yeah.
Brent? For the audience, this guy was like a legend of the legends in the I believe it was 1970s and 1980s and into the
Yeah.
1990s.
Spoke at our conference many times.
Really?
Yeah, absolutely.
That's awesome. That's one of the coolest things I've
You
heard.
you have shared this stage, graced the same stage as him. So
That's wow. That's surreal to say the least. But Marty, I looked at his, I think he's got 12 or 14 rules of investing.
mhm.
And the number one rule was follow the trend. Follow the trend. And so right now, if you look at a chart of gold, or if you look at a chart of silver, or if you look at especially a chart of the GDXJ, my goodness gracious, what an awesome looking trend you've
Yeah.
got there. And I've just, this isn't investment advice or anything, but for me, I'm looking to add to my GDXJ position, if we get a little bit of a pullback. But yeah, so what are your thoughts as far as gold being at an all-time high and whether that should potentially deter value investors?
Yeah, a few things on that actually. Talking about trading and looking at markets on trends, an old friend of mine, Dennis Gartman, who took a lot of heat in the social media because he was so often wrong, and admittedly so because he took positions publicly in every market every day. So he was going to be wrong a lot. But one of his adages was, if you have a winning trade, you add to it.
Yeah.
In for one unit and it's working for you and it does, then add two, then you follow that trend and add to it rather than, buying more and averaging down at the bottom, which, kills so many people. All-time highs, I would add to what you said, which I think is absolutely correct, that you look at gold as insurance. I say there's 2 reasons to buy gold, to own gold. One is as insurance, the other is as investment.
Mhm.
And
Yeah.
the insurance part is if you think if you have free cash or available cash sitting in your account, and you feel that 3, 5, 8 years down the road, the purchasing power of that cash is going to be significantly lower. If you put that in gold and silver right now, history says that it is most likely going to protect you from that depreciation over that time frame. And that's why, if you look at all of the modern portfolio theory, if you have a certain percentage of gold in your portfolio, you're much closer to that risk-adjusted return, or you optimize your risk-adjusted return over time. It works.
Mhm.
Now, the other side of the coin is when you're in one of those periods when gold is making up for lost time. Gold's not an inflation hedge, because inflation will go up 2 to 3% a year and gold won't budge for many years. But when people start to really worry about the future purchasing power of their dollar, then they freak out and they rush into gold, and gold makes up for lost time, and it really takes off. If you look at the macro picture and feel that gold is in one of those catch-up periods where the price will be rising relative to the dollar significantly, then that's when you have to look at it as an investment and either buy, any one of the wide spectrums of ways to play gold. But one of the ways that we look at is, the leveraged assets like mining stocks and silver and other natural levers to gold. So you can play it that way from the investment angle, but I always recommend that people look at gold first and foremost, if they're getting into the sector, as insurance, and try to get their physical component in line.
Yeah, I think that's a great way to put it. You've got to compartmentalize gold into 2 buckets and determine what your objective is in buying it, because there can be, speculative. I always look at it as a speculation. And if I want to speculate on gold, then I'm going to go into silver or then I'm going to go into the miners. But if I'm just buying gold just as an insurance policy or to have purchasing power outside of the system with no counterparty risk, then
Yeah.
then I'm going for physical gold every single time.
Yeah. One of my bullion dealer friends, I was just talking to him about this recently. He was talking about some of his clients that are selling their gold that they bought from him years ago. And they said, oh, when it goes down, I'll buy it back. And he's telling them, no, you won't. You're never going to buy it back because you're going to think it's going to go still lower. And it probably won't be going any lower. So you're never going to buy it back. And my point to him was that they bought it for the wrong reason to begin with. They're cashing out on it. And what are they holding now? They're holding cash that's going to depreciate at 5% per year going forward, as opposed to gold that is, at least relative to the dollar, going to hold its value and protect against that depreciation. So they're taking a guaranteed loser. They're taking the insurance policy and cashing it in for a guaranteed loser.
Yeah, but it goes back to the psychology as well. And that question that I had in RoboCapitalist Pro, it implied that because gold is at an all-time high, we're seeing kind of a blow off top, that this could be, from here, it's got nowhere to go but down because we've exhausted all of the buyers, right, to get it up to all-time highs to begin with. But if this was a mania, if this was hysteria, if this was FOMO, if this was a blow off top, you would not have the majority of retail investors or retail buyers coming in and actually selling. The buyers of the past coming into you would see the exact opposite. You would see, I'm guessing you would see a huge premium in spot relative to I don't know how that works, but
you would be seeing backwardation. You would be seeing premiums in small physical bars in coins, and you're absolutely not. It is at near historical lows for the premiums over bullion.
That really tells you, and again, I think that shows that it's such an opportunity, that it's got such an incredible trend. It's at all-time highs. But it's done that with the opposite from the retail side. So what happens if retail starts to bite again? And I guess the question then becomes, what would prompt that? Like, what would be the catalyst? And I think unfortunately, it goes back to the whole casino that I was talking about. It's all simply a function of price. And if we were to go, let's say, a year, and gold continues to go up and the miners really start to rocket, and at the same time, let's just hypothetically say that Bitcoin doesn't really go anywhere, or it goes back down to like 100, and you start to see kind of Nvidia go down, and maybe the Mag 7 are down maybe 10-15%, then I think you're going to see retail. They're going to be looking for a home. They're going to be looking for that next dopamine hit. And I hate to put it that way, but I think that's just reality. I've got a good buddy, Brien, you'll enjoy this story. He's a real smart guy. He's a software engineer, and he knows that especially with these, we'll call them S coins to keep it family friendly here. I'm not talking about Bitcoin or even Ethereum. I'm talking about the real, fart coin and whatnot.
Right.
He knows it's a total joke. He knows it's a total scam. He knows every single one of these is basically just a massive pump and dump. But he kind of has an inside track with some of these private Telegram groups or whatever.
Yeah.
And so his whole portfolio is really prudent. I think and if anything, it's conservative. But he has this one section, teeny like 1% or whatever, that he's just like, let's just, throw it on red and see what happens. And so remember when Elon came out and was hinting that he was going to start a new political party, like the American Party or something? So my buddy is on these Telegram groups, and he's like, oh, you know what? I'll bet you someone is going to start an American Party crypto, like token. That has nothing to do with Elon, but just as like a pump and dump.
Yeah.
Sure enough, that's exactly what happened. And he knew the right guys or gals or whatever to get like some coins before they really started to pump it. And he bought like $1,500 worth of coins. And 2 days later, he sold it for 50 grand.
Yeah.
And so, and then that next weekend, we went out to dinner, and he said, what's really interesting is the psychological component there, because now when he looks at his other investments or adding to a position, nothing really excites him unless he can get like a 1000x in 2 days or, or a week or something like that. And he knows that's bad thinking. But he's self-aware enough to analyze those thoughts. And, that's what we're dealing with right now. That's what we're dealing with. So, I think that's going to be the catalyst, is what I'm trying to say. When these cryptos start tanking and the AI starts going down, or at least flatlining, and then the only other option out there with this FOMO and this gambling attitude is going to be the miners. And I think there's a high probability we get there.
Yeah, I think that's a big part of it, obviously, and it will come at some point. But again, we don't need that much of. We don't need all those crypto bros to come over to the sector. And what's different now, I think, is, I've been talking about this current market, particularly for the mining stocks, as being generational in scope, because the last time we saw anything like this was the early 2000s, literally 2000, 1999, 2000.
Yeah.
25 years ago. And at that point, the mining stocks, they were bombed out, all-time lows, but so was gold and so was silver. And you had to have a lot of courage to take your cash and bet on gold, silver, and mining stocks at the time. Well, today, the hard part's been done for you. Gold is at record levels and heading higher. Silver's breaking out. And the mining stocks have come a good ways, especially the majors at this point, but they're still, again, valued near all-time low levels on every classic valuation metric. With the quarterly reports, like the Q2 reports, Newmont Mining had twice the earnings of Tesla, and they have 1/13 the market cap. So that's where, and that's obviously, there's an argument there that Tesla is way overvalued as well. But if they meet in the middle, you've got a 6x on Newmont from here.
What were the PE ratios of these miners, if that's the metric you're using, back in 2011 or during at the peak of that mania,
I don't know,
versus today? Do you have any idea?
No, I don't know. That would be an interesting chart. I might need Bloomberg for that one, but
but my guess is the valuations are way lower today than they were at the peak there with like Newmont or something that was, you would assume, would be kind of tied at the hip with gold. In fact, I was listening to Peter the other day, and he was talking about how, I believe it was Newmont, is the best performer in the S&P 500 this year, with the exception of Palantir.
Yeah, it is. And Newmont is the only gold mining stock in the S&P 500. So it is the natural port of entry for generalist investors as well. But, these things, they're not wealth creators. Well, they might be wealth creators, but they're not long-term holds. They are timing instruments. 20 years ago, you could buy Barrick at the same share price. They are ways to play a trend.
Right.
And if you get down into the juniors, they're burning matches. You got to hit it, during that window when the company has money and is developing something, and you're in the right part of the cycle.
Yeah, it's almost like a call option.
Yeah, they are. And silver is interesting because it's an option both ways, because it leverages gold both ways. It doesn't expire, but it goes down much quickly as well.
Yeah. So when you say that we don't need to have all the crypto bros, and we don't need it in order to achieve what? Like what? You see what I'm saying?
Yeah. We don't need it to get kinds of returns that would really excite a market. In the 2000s, the junior mining market was extraordinary in that first off, you had a rising tide was lifting all boats. So instead of your loser in the junior miners losing 50% or more, it might be staying even and might be only going up 50%. And your winners were going up 3-4x, being taken over, or you would sell, roll it over into another one that would go 4 or 5x. Then every now and then you would have a 10x. Every now and then you'd have a 20x in your portfolio. And it was the most extraordinary, rapid buildup of wealth.
Over what time frame was that, Brian?
2000 to 2011 with
Okay.
a short, hiatus in 2007,
Okay.
or 2008 rather. But it was an extraordinary period to be in the sector. I think we're looking at those kinds of returns again, because we've had, I count the 70s as two bull markets, early 70s and late 70s. There was about a 1-year bear market, 75 to 76. And that was pretty severe. Gold went down 50%. So it was, I think a clear bear market. So if you look at the potential for gold, you mentioned earlier that is gold topping out now? Is this as far as we're going to go? We're in uncharted territory here. So I look to the previous bull markets to get an idea of where we could go. In the early 70s, the gold price went up 5.6 times from the low to the high, trough to peak.
Mm-hmm.
In the late 70s, it went up 8.2 times, trough to peak. In the 2000s, it went up 7.6 times from trough to peak.
Mm-hmm.
If you mark the low for this cycle in December of 2015, as I do, at like $1,050, that means we'll peak out at somewhere $6,000 to $8,000.
Yeah.
Range. Now, there are other people interpret it differently. They lump the 70s as one big homogeneous bull market. If that's the case, then you're looking at 24x from trough to peak.
Yeah.
And that at that point you get into, are we going into a new financial monetary regime where they're going to back back M2 with gold to some percentage? That's when you can get into those numbers like $20,000, $30,000 gold price. I'm not predicting that, but I'm recognizing a trend here that gold is telling us something. That this gold price has risen because at least the central banks feel there's something ahead. I think that, yes, they want to protect themselves from the dollar weaponization, the U.S. hegemony. That's definitely a big part of it, probably the majority of it. But I think they're also looking at the fiscal situation in the U.S. and indeed throughout the West and developed nations where debts, after 45 years of ever easier money, the debt accumulation has risen to such a level that it's really putting a bind on, structurally on fiscal budgets. And will going forward if interest rates remain at these levels.
Yeah, I would side definitely with the counterparty risk on the central banks.
Yeah, but I think that's
also,
part of it. And it's really, how do you define that? If you're looking at a rapid depreciation in currencies, that's a risk. That's a counterparty risk.
Yeah, it can be. But I mean, most of their expenses are not most. A lot of their inputs are denominated in dollars.
Yeah.
So if their input is denominated in a dollar, then it's going to be advantageous. And if they do hold gold, there's going to be some FX risk there. There's definitely upside for sure. But they're taking additional risk that they otherwise wouldn't with like a treasury that was paying them, let's just say 5%, compounded. That might not keep up with the rate of inflation in the United States, but at least you're not taking that FX risk. So and especially with the commercial banks as well. The commercial banks, they're just pocketing a spread between their liabilities and their assets.
Mm-hmm.
So I don't think they care about what the dollar does versus goods and services in the United States. They could care less because to them it's free money. And so to them, it's just a matter of, do I want to take my balance sheet and allocate it towards treasuries, or do I want to take my balance sheet and allocate it to lending into the real economy? And if the real economy isn't doing too well, if there's risk there, then the no-brainer answer is just treasuries, because risk reward, that's just going to make sense because they're not taking their own money. They're just taking the delta between the assets and the liabilities.
Yeah.
So,
and commercial banks, if they're in, to the subject of gold, at least, if they're in gold, they're just doing it as a trade anyway.
Yeah. For a commercial bank to buy gold, that's very risky.
Yeah.
Because you've got dollar denominated liabilities. And that was part of my point with the central bank there. But with the central bank, they're not at risk because they can't go bust. But with the commercial banks, they've really got to be cognizant of that. So if you have dollar liabilities, you really need to match that up with dollar assets.
Yeah, and I guess my point is that the central banks are looking at that the dollar as being a loaded gun. That sure, when they're on our side, they're all aiming that gun at Russia.
Yeah.
But at some point, that gun can turn around and be aimed at them as well. So I do think that's a big part of it. But I think they're also looking at the possibility. Well, maybe they're not verbalizing it to their friends at the cocktail parties, but I think they're looking at the possibility that this financial regime is going to need something to get the credibility back, the way the debts are demanding a depreciation of not just the dollar, but I think fiat currencies in general. And that whoever has the gold at the end of that process, at that cycle, is going to be able to make the rules to some extent.
Yeah, there's a lot of variables there because I've got I think a different vantage point than most Americans because my expenses aren't denominated in dollars.
Right.
They're denominated in Colombian pesos. So for me, if I'm holding a treasury, let's say, or a dollar denominated asset, I don't care about what's happening with the CPI in the United States. It impacts me. I get sticker shock when I go to your conference and I say, holy cow, bottle of water is $18. So I definitely get the
go to the green room for your water. I'm buying that.
Exactly. But for most of my day or most of my year, all I care about is the dollar relative to the peso and then the local inflation rate. So as an example, I started coming here, Brian, I think in 2014, and the peso at the time was right around 2,800, right around there. And it's appreciated a bit over the last 6 months, but about 6 months ago, or maybe 9 months ago, it got up to 5,000. And why that matters is because although the local inflation rate has been higher than in the United States, it hasn't been that much.
Yeah, it hasn't made up a difference. No,
Absolutely. So by holding those dollars, even if I wasn't getting a percentage return on treasuries, my purchasing power in local terms would actually be going up relative to goods and services, even though it's going down in terms of dollars, if that's what my expenses were denominated in. So I think those central banks, unless they're on the dollar for some reason or something, that's a bigger priority for them. It's not necessarily what the dollar is doing relative to goods and services in the United States. It's more so what the dollar is doing relative to their local currency. Now, to your point, if the dollar is really going down substantially, then that could be a problem for them. And maybe that is some of the motivation behind what they're doing.
Well, if you look at the relative percentage of central bank holdings, central bank reserves, you look at the dollar's percentage and it's been falling, and you look at the gold's percentage has been rising, and its two lines are pointing toward each other. In fact, one of the very popular commentators, I won't mention his name because I think he's wrong in this respect, said that gold just beat U.S. Treasuries as a component of foreign central reserves. And I don't believe that, because I think all of the dollar holdings are in treasuries, and all the figures I've seen, they're still pretty far apart. But regardless, again, if you look at the trends, one is down and one is rising. I don't think they're going to cross in the near future anytime soon, but there's a preference being shown there.
Absolutely.
And we passed up the year, gold has passed the euro up. I don't think that's much in play anymore as one of the two preferences.
Yeah, I completely agree. I just think that the private sector, especially with the banks, the commercial banks, don't have that latitude. They don't have that flexibility because they can go bust, and they can't have negative equity that long, where they can't be insolvent, where the Federal Reserve is a prime example of the ability for a central bank to have negative equity, which they have had since, I think, 2021, something like that. If you take away that accounting gimmick, it's called a deferred asset or something like that. It reduces the liability side of the balance sheet. But without that accounting gimmick, which would be completely illegal by GAAP standards, or if a corporation did it, they do have negative equity, and nobody even knows. Like, you got to be a wonk like me to even know that that's an issue on the balance sheet. And the private sector doesn't have that. So I think there's a different set of maybe priorities. Especially, you got to think, if I'm a central banker and I know that I can't go bust, but I do know that my dollar assets can be frozen. Jeez. I mean, is there any better motivation to buy gold or something that just doesn't have that counterparty risk? I don't think so.
Yeah, and I think it is a primary motivation. There's also, and I think it's really doesn't have that much of an effect, or will have that much of an effect. But the latest thing that people have been talking about for the last couple of years has been the Basel III regulations for gold, where gold will be listed or is listed now as a tier 1 asset representing zero risk. So banks can hold that and pass their stress tests more easily, et cetera. Doesn't seem to be much that has come of that.
I think it goes back to what I was saying, Brian, because they've got dollar liabilities. And even if they're allowed or incentivized to own gold now, I wouldn't do it if I was a bank. I mean, there's no way I would take that risk. Absolutely no way. I might do it with some cash, some equity. But as far as, the main thing that all a bank is doing is really just managing a balance sheet at the end of the day. And they're just trying to get as much interest versus the risk that they're taking. So what you want to do is you want to eliminate as much risk as possible. And if I'm a bank with a dollar liability, there's no way that I'm buying gold. Another way to look at that, Brian, is if you own a rental property, and let's say you've got a mortgage payment of $2,000 a month, would you accept your rent payment in Bitcoin? Assuming that you had to hold that Bitcoin? The answer is no. There's no way you would. There's no way, because it's just too darn volatile.
Volatile, yeah.
There's no way. Or would you price your rent in Bitcoin? Or would you even price your rent in gold? There's just no way, because you've got that dollar liability. And although you might have some upside, but you're not in the game of speculating on the price of gold, for heaven's sakes. You're in the business of pocketing the spread between your rent payment and your mortgage payment.
Yeah, and they're not looking at the depreciation in that currency, because they need that currency right now to pay their bills and loan out, and they're always going to be in that game. So even though it's depreciating on the other side of there as well. Getting back to gold as insurance, if they looked at it over the long term, there's a great website called pricedingold.com. And what the guy who runs that site has done is taken various assets and indices and just priced them in gold. And if you do that, and he's done it, you look at his long-term charts and you see that the S&P 500 priced in gold is the same level as it was in the 1930s. The cost of an Ivy League education is the same price today in gold as it was in the 1930s. It took the same amount of gold in 1935 to buy a Harvard education as it does today. So gold, again, is insurance. It protects against that depreciation over long sweeps of time. You can go in and you can cherry pick the beginning and the end of any trend, but over history, it is the great moderating factor. It is the center of the financial universe around which all of the values revolve.
Yeah. And I think the main point that we're trying to make here, or at least the main thing I'm thinking about in terms of my own portfolio, is what inning we are in.
Yeah.
In not setting aside the insurance, I completely agree there, but just more so from a speculative standpoint, what inning we're in as far as the price of gold, and maybe more important to me right now would be the miners and silver.
Yeah.
And just, I think that psychological component we were talking about is so vital, because I think the central banks are hugely incentivized to continue to buy, because I don't think their counterparty risk is going down. I think if anything, they see what's going, I'm not going to talk about Trump, but they're seeing what's going on with the administration and say, holy cow, this is a tinderbox right here. I better, get rid of as many dollar assets as I can. But then more so, that the biggest thing we've talked about for me, Brian, is the retail. The retail is a net seller right now.
Yeah.
And so, if the retail's a net seller right now, I don't know how we could be more than inning 5. I mean, what inning would you say we're in?
If if I look at the gold price and say that we're about halfway there for where this cycle will take us,
Mhm.
yeah, then I'm saying, fourth inning, something like that,
Yeah.
fifth inning.
Yeah, I agree. I
I,
agree.
I, I would say, but it's the biggest moves, come toward the end. I don't know what it's going to take to get the speculative FOMO investors to buy gold at these prices. I mean, the trend will have to continue.
Yeah.
But I think they're going to go into it looking at leverage and looking at mining stocks and silver. And, silver leverages gold, but you can get silver stocks that leverage silver so you can stack your leverage. And I am preaching that right and left these days, that these silver stocks, they've moved a good bit, but these junior silver stocks are the most explosive area I see going forward. We had a little run in the spring of 2016, and across the board, they all quadrupled and quintupled over
Really?
6 months. Over 6 months, they can move and will move. And again, silver's popped over $40 today on a spot.
What have the silver miners done?
They have the ones in my portfolio have basically doubled this year.
Okay, but nothing compared to what they
could do. Yeah, I'm thinking that these across the board, they're going to be 4 or 5x. Now, don't quote me on this. This isn't investment advice, but I can tell you what I'm buying and what I'm expecting. And that's really what I'm expecting because I've seen it before.
What would prompt? So let's set aside the gold as an insurance policy, because I'm sure you've got a significant portion of gold that you'll just never sell at any price. But looking at it through the lens of the speculation, the miners, silver itself, what gets Brien to sell? Like at what point are you like, okay, you come on the podcast and you're like, George, I see a massive mania. I see hysteria. I'm going to start reducing my position size because I think this could be the blow off top.
I don't know that I'm going to be that smart. I hope I am. But look, on evidence, I am not going to be that smart. I have been through a few cycles. The thing that I have learned over the cycles is not I'm hardly ever all in or all out. Right now, I'm all in.
Okay.
But it is one consideration, and it's a kind of problem you want to have. But when a market like this, like it got going in the 2000s, you have to manage, you have to discipline yourself to every now and then just take money off the table, because the capital gains are coming in on paper almost like income, just like steady. And when you sell a stock, whether that's because the company has been taken out by a larger company, or you've got what you think you're going to get out of it. When you sell a stock, you hear another good story and you tend to just roll it over into the next story. Mm-hmm. And I've been through some bear markets and crashes before, and you don't want to be rolling over and still be all invested when that crash comes or when the bottom starts to fall out. So I advise people to just, again, dip a ladle into that flow of capital gains, take it out of the market, take it out of your brokerage account, put it into something relatively illiquid, put it into real estate or income producing real estate, or something that's where there's at least a couple of steps that you have to take to put it back into the next hot story. And just fund, your investments in that sector by a portion of your gains, but take money off the table. And I hope that's going to be a problem again, or an issue to be addressed, but it's getting to that point right now.
Yeah. So it sounds like managing psychology, which is
and being aware, know thyself and all of that. It's one thing to hypothetically and from a detached level look at the market and say, well, this is people who have euphoria, they have despair, and then to turn it inward and recognize when you're riding the same roller coaster to some degree, at least, that you're warning people against.
Yeah. At the end of the day, the psychological component of fart coin is the exact same as the silver miners, right? We're not human, regardless of our asset of choice.
Absolutely. It all works the same. Human nature never changes. You know, those back in the Roman Forum, there was a George Gammon walking around in a toga saying the same things you're saying right now.
Yeah, exactly. Brien, tell us about New Orleans this year.
Well, you know, we're in a metals and mining bull market. And one thing that 50 years of history has proven, that when you're in a metals and mining bull market, you want to be at the New Orleans conference. It's always proven to be the place to be, to really maximize your gains and find some really explosive companies in our exhibit hall. But from our general session stage, you know, we've got, I think, from top to bottom, one of the I mean, you're in the industry, you know how hard it is to get the really good speakers out there, and you appreciate who the best speakers are out there. I think we've got a tremendous lineup this year that anybody who is really a serious investor and knows who the best thought leaders are will look at our roster and realize that, you know, this is a place or the place to be right now. I'm just going to read off some of our speakers because I can't remember them all.
No, please do.
Matt Taibbi, Rick Rule, George Gammon, Danielle DiMartino Booth, Brent Johnson, Peter St. Onge, Viva Free, Robert Kiyosaki, Peter Bookvar, Jim Bianco, Jim Iorio, Adam Taggart, Peter Schiff, Adrian Day, Alex Green, Dave Collum, Robert Prechter, and Lawrence Lepard. Dan Oliver is a great new speaker this year. It goes on and on and on. And, you know, that's my business model. I'll just build value and value until somebody just can't resist coming to the event.
Yeah, Viva's going to be there. I don't think he's been there before, has he?
No, he hasn't.
That's going to be fun. He's a great dude.
Yeah. Yeah. You know, I think there's a number, as you know, better than anyone, there's a number of very important issues out there right now as far as, you know, personal liberty, free markets, free rights, et cetera, and censorship. I think Matt Taibbi is the most important journalist of our generation, you know, and Viva is on the front lines.
Yeah, he is. Yeah, he's a hell of a bowler too. Did you know that?
No, I did not know that.
Yeah, no, he's good. Like, he's really good. Anyway, where can people get the tickets, Brien?
NewOrleansConference.com, and you should have an affiliate link of your own as well. But NewOrleansConference.com, very simply put.
Or we'll put a link in the description below. And it starts November 2nd?
November 2nd to 5th. So it's coming up rapidly.
Awesome. Buddy, thanks a lot for your time. Great conversation.
Thanks,
Look forward to seeing you in the Big Easy.
You got it. I'll see you soon.
All right.